Bob English here in Washington, D.C., and here is a story we're telling today. Is it 2008 redux? That is a question on everybody's mind. Are we in store for another financial crisis? But handicapping the ultimate fat tail risk, which would be, well, the end of U.S. dollar hegemony, has been the death knell of many trend forecasters over the last few years. So let's look at the evidence, keeping in mind that clever line from Mark Twain about history rhyming, not necessarily repeating. Now, when the Fed stopped buying bonds and instead sold them in the summer of 2008, short-term funding markets seized up. There was a mad dash for cash, which precipitated the Lehman disaster. Now we have talk of tapering, another wind down of bond buying. But so far, it's just talk. The Fed announced it's requiring banks to hold more capital and reduce leverage, all part of Basel banking regulations. And the word from our Fed chairman above is that banks need to lower leverage. Later, Perianne Boring will break down rehypothecation and explain where all this leverage comes from. Now, we know the banks are borrowing on the cheap, and so is Uncle Sam, thanks to them. So what happens when the 30-year downtrend in interest rate reverses? We'll be talking to Karl Denninger about this in just a bit. Heading east, we see Chinese short-term funding markets are under incredible stress. Their yield curve is flashing recession, if not depression. Justine Underhill will dig into the nuts and bolts of this 2008-ish development. Finally, we'd be remiss here at Prime Interest if we didn't mention the Winklevoss, or is it Winklevi twins, but they're creating a Bitcoin trust. So that, yes, it means a Bitcoin's IPO. Soon you'll be able to short Bitcoins. A sign of the apocalypse? Probably not, but we're sure this has JP Morgan's attention. So without further ado, here's what's in your Prime Interest. In June, interest rates on 10-year Treasury bonds and mortgages rose to the highest level in 15 months. Despite this, we have been in a 30-year downtrend in long-term interest rates. Earlier, I spoke with Karl Denninger, blogger at marketticker.org and author of the book Leverage. So I asked him first about what lies ahead for the Fed's near-zero interest rate policy. Here's what he had to say.
You certainly can't go below zero now, can you?
We can try. Mario Draghi wants to.
Well, even that only buys you a very short period of time because you can't go very far below zero before there's a revolt among the people who have capital. So certainly you could try to extend that like Mario has suggested. I don't think it's going to work out very well for him. But the general problem with the declining interest rate environment over time is that people get very accustomed to the idea that they can turn the leverage crank, and by doing it, they essentially print money. People talk about central banks printing money, but in point of fact, it is the commercial banks that are the ones that are issuing the unbacked credit into that kind of environment.
Well, yeah,
all you're doing, though...
I'm sorry, that gets to the money multiplier and everything. People talk about the fact that money velocity itself is not a factor. What is your view on this?
I think that people are looking at the wrong thing. You have to look at the sum total of money and credit in circulation, not just currency. Everyone wants to talk about things like M1 mult and you know, the other multiplier factors. But those are based upon, for example, M1 or M2, and they don't take into account all the credit flying around in the economy. But the Visa card in your wallet spends exactly the same way as does the $20 bill. So anybody that gives a bit of thought to this should come to the conclusion that you have to sum those two things together, and nobody does. The problem with continuing to increase leverage into a declining rate environment is that essentially you're robbing Peter to pay Paul. You're taking a forward liability and handing it to somebody and pocketing the asset side of that in your own pocket. So you haven't actually changed the outcome other than the fact that you've deferred it. It's the Wimpy paradox from the Popeye cartoons, where he says, I will gladly pay you next Thursday for a hamburger that I wish to eat today. Then Thursday comes and you turn the crank again and do it all over.
Well,
This doesn't change the fact that sooner or later you must pay for the hamburgers.
You certainly do have to pay for those hamburgers. Let's talk about the money supply. There's M1, M2, but there's also M3, which is the broadest money supply aggregate, and the Fed no longer computes that, and that includes elements of the shadow banking market. So what are we seeing with these money aggregates that are not being computed by the Fed now?
Well, M3 is meaningless. I actually support them not reporting it because it doesn't mean anything. All you have to do is take a look at the Fed Z1 and sum up all the liabilities, all the debt that's in the system, and that tells you what's really going on, because every asset, every dollar that is in your wallet, whether it exists in credit or physical form, is in fact somebody else's debt. Just pull out one of these pieces of paper out of your wallet. It says Federal Reserve note right on the face. What is a note? A note is an evidence of indebtedness. So, it's not very hard to figure out what's going on. The Fed publishes all the information you need every 3 months.
And unfortunately, most people don't pay attention to it. Let's pay attention to Bernanke right now. He's not going to Jackson Hole this August. He might be out of a job next January because he doesn't want to renew his term. What do we have in store for the Fed? Is it going to be Janet Yellen, Geithner? Who might it be?
I don't know. Handicapping that is somewhat difficult. If Yellen is elevated, it would be the first time, I believe, that that's ever happened.
Yes, for a vice chairman.
That position. Right. So it would be a very rare thing indeed. I don't think Geithner has any chance of being elevated. I'd be very concerned about somebody like Larry Summers being given the job. Oh, boy.
We also have Stanley Fischer, though. I mean, the head of the Bank of Israel. What about Stanley Fischer?
Well, there are a number of people that I think would be very interesting picks, but it's my position that the Fed has essentially boxed themselves into a corner. And the Bank of International Settlements has made this rather clear. They've said, look, you guys turned this crank. You maintained this credit issuance by essentially absorbing all of the net debt issuance of the federal government over this 4 or 5 year time period. So you've allowed that to happen, and you've continued the deceleration towards zero of the interest rate curve. But now you're at zero.
So, yeah, what are you going to do at zero? And we've seen it is possible to break the bank. I mean, George Soros did it. So there is a precedent. I mean, can you talk about that?
Yeah, that's the problem, is that the Fed, as it continues to take the leverage onto its own balance sheet, becomes more and more at risk. That's not to say that the Fed would outright cease to exist like a commercial bank, but
no, I don't think it will either.
No, but the disruptive effect that would come from a recognition of insolvency would be rather large. You could see interest rates spike, 400 or 500 basis points in the space of a few days. We've certainly seen that kind of thing happen over in Greece and other places in the past. It can happen here in the United States. And once the margin clerk is on the phone and he wants more capital, you either poke it up or else he liquidates whatever you have.
Yeah, and let's talk about interest rates spiking by 400 or 500 basis points, which is a full 4 or 5%. I mean, it's incredible to think about. And at that point, the Fed basically still has to pay banks to keep all these excess reserves in the system. Is it possible that the Fed could go cash flow negative, that it could actually have to realize capital losses on its investments?
Sure, but that, they'll just defer those, and what will end up happening is that they won't remit anything to the Treasury for, the next 100 years. In terms of functional insolvency, it's different than being in a position of being capital negative. The problem is the credibility loss that happens, and the fact that once you're unable to continue to manipulate the market in that sort of a fashion, rates go to where they're going to go. And everybody else in the market doesn't have the luxury that the Federal Reserve has of not meeting margin calls, because the Federal Reserve, where's the margin call come from? It comes from Treasury, and Treasury just declines to issue it. But when you have a margin call coming from your broker, you can't turn around and refuse to answer the phone. It doesn't work that way.
No, it certainly doesn't work for most of us like that. Let's talk about Fannie and Freddie. There's a lot of talk about them being wound down, and there might be somebody new who's coming in to turn things around. There might even be a new mortgage security giant that is sponsored by the federal government. Are we going to see anything different?
I don't think so. The real problem here is that we have had a 30-year history of driving asset prices higher, not by productivity, not by improving the technology that we have in our, in our economy. Of course, some of it has come from that, personal computers over the last 30 years and things like this.
Yes.
But the largest quantity that has driven asset prices higher has come from credit expansion, and that requires a continually declining interest rate environment. So as rates start to reset, asset prices come down. And the last place you want to be is leveraged when that kind of thing happens. It's like anything else. When you use leverage, you gain a percentage for each time you turn the crank. But when it moves against you, that multiplier works in reverse exactly the same way it worked to your benefit on the other side.
So let me ask you this question. Where would you be in terms of assets? Where can people protect themselves against what you see as this rising interest rate environment, which is crippling in terms of the Treasury debt?
Tangible things that you can either use to produce and are difficult to tax. And that's a tough call, okay? Because remember, as the government gets in trouble, one of the things that it has a history of doing is trying to tax its way out of the problem.
Yeah, capital controls.
So you want tangible things. Of course, intangibles, such as what you have in your head and what you're able to produce with, are very useful. And believe it or not, so is cash, because at the time that people have to puke up assets to meet margin calls, you have opportunities to step in and buy things that are productive. People during the Depression that had capital became very wealthy, not immediately, but over the space of 10 or 20 years, because they were able to buy things like manufacturing facilities and and hard goods at 5 cents on the dollar.
Oh, we saw that in 2007 and 2008 too. I mean, there were a lot of deals to be had at that time. We have about a minute left, so let me just get your take on Apple and this whole deal with offshore taxes. What can Apple do to regain the faith of the people?
I don't think Apple can do anything to regain the faith of the people. The evangelical head that they had that drove much of their adoption over the last 5 years isn't around anymore. And frankly, I haven't seen anything in the way of true innovation out of the company in the last 3 product cycles.
So, okay, we have 30 seconds left. We have Bernanke. He might be leaving the Fed. We have somebody else who's going to come in. What is the future of the banking system of the U.S.? Are we going to see real change? Is it possible?
No, we have to. It's mathematical certainty. You're going to see a rising rate environment over the next 10 to 20 years. And it won't be all at once. It won't be a straight line, just like it wasn't a straight line on the way down. But this is the change in dynamic. And there is nobody in the business world that is younger than 60 who has lived in that world at this time.